is it different this time? My next guest says U.S. consumers may be wary during this recovery, just as they were in 1992. But the difference this time may be found more in active consumers in places like China, India, and Brazil. Randy Bateman is the Chief Investment Officer at Huntington Asset Management, and he joins us from Orlando. Randy, welcome to the program.
Good to see you.
Randy, explain this sort of correlation that you're drawing between 1992 and what we're experiencing now. Give us more details.
Oh, certainly. You know, if you think about it, back in the 1980s, we went through a major period of delayering of management, downsizing of businesses. White-collar workers were being laid off pretty much en masse. Basically, for the first time we've ever experienced that. We had gone through a period where we became somewhat globally uncompetitive, and business recognized that, and they started to expend that labor and that labor cost in terms of making some major consolidations with their white-collar workforce. So we went into a recession in 91, came out of it in late 91, early 92, and it was a very sluggish economic recovery, and it was sluggish primarily because historically our economic recoveries are prefaced by a very strong consumer. Consumer comes in first, then business starts to spend, build inventories, plant and equipment to meet the demands of the consumer, and then more tax rolls so the government can come in and spend. We saw that completely opposite occurrence in the 1992 economic recovery. The consumer was very wary. Coming after this period of downsizing, delayering, they did not want to spend. And so consequently, we had a very sluggish recovery because the consumer's two-thirds of the economy. But what we did see, we saw business spending very, very robustly. Year after year, 30+% rates of growth in business expenditures. They became much more competitive. They wanted to find ways for each unit of labor cost, they wanted to expend that in the most productive fashion. And
so Randy, would that mean, let's say, more spending on technology, for example?
Absolutely, absolutely. And we saw that during that period. Now we're coming through another period that I think is very similar. We've seen the destruction of a lot of people's net wealth. The 401ks have gone down during the 2008 cycle and early 2009 as well. We've seen the destruction in equity in many people's houses, which in most cases it's their largest single investment. And I think they're going to be very reticent to carry this recovery as strongly as they traditionally do.
So does that mean that we have to then find new consumers? I mean, are the consumers in places like Brazil and India and China, are they the ones that are going to lead the world out of a global recession?
Most definitely. I think we're going to see this handshake take place between the U.S. consumer and consumers as there's a building middle class in India and China and Indochina, Indonesia, Brazil, and in Russia. I think there's no question about that there's going to be this definite switchover from our consumer to other consumers. But that makes perfect sense, and we'll be in a good place and a good advantage to be able to hopefully take advantage of that in our own production cycles.
All right.